On a Thursday in the middle of 2010, a man named Navinder Sarao was trading stocks from a bedroom in his mother's West London home. His laptop was connected to the American financial markets, which were experiencing higher than normal levels of volatility.
All right, you're looking at what's going on in Greece right now. In the US markets, financials causing another leg down.
The large minute-by-minute swings created fertile grounds for huge trading profits, and by 7:40 p.m, he logged off for the day, raking in nearly $1 million in profits. All the way over in New York, the local time was 2:40 p.m. A bad day for the market so far, but still just a couple of percentage points down from when trading started that morning. But just 60 seconds after Navinder logged off for the day, all hell broke loose.
We have not seen a day like this.
What the heck is going on down here? I don't know.
I'm looking at Eurodollar futures. We're down 13.5 basis points.
Down nearly 900.
I mean, there is fear. This is capitulation, really.
Within 4 minutes, the stock market was down almost 10%. $1 trillion of value wiped off American companies in minutes. The day became known as the flash crash of 2010, one of the most violent and unexpected collapses in stock market history. A crash that exposed the dark side of a new wave of algorithmic trading, ushered in sweeping financial regulations, and revealed a fascinating story of a lone UK bedroom trader who abused loopholes to make tens of millions of dollars. So, what exactly happened? It was the 6th of May 2010, and when trading opened at 9:30 Eastern Time, it was immediately an unusual day. New information regarding the European debt crisis had come to light overnight, and traders were responding to it. There's an index called the VIX, which tracks market volatility, how violently stocks are changing in price. It's also referred to as the Fear Index, and by 2:30 p.m, it was up 22.5%, indicating that this was already a very turbulent day for the markets. The S&P 500 index, which tracks the US stock market, was down a couple of percent. Then at 2:32 p.m, something really unexpected happened. A huge block of E-mini S&P 500 futures was dumped on the market. These are a type of financial contract that traders use to bet on the movement of the stock market. Don't worry, the details aren't that important yet. But someone suddenly throws 75,000 of these contracts at the market, a total value of $4.1 billion. It's a huge shock to the system, and just 9 minutes later, stocks plunged 3% in a matter of minutes. By 2:45, the market was down nearly 10% on the day. At the individual stock level, things are even more chaotic. 2 billion shares are traded between 2:40 and 3 p.m, a total volume of $56 billion. About 20,000 trades are executed at prices more than 60% above or below where they were trading just a few minutes earlier, some at completely irrational prices. ACN, the stock representing Accenture, fell from $40 a share to 1 cent within 7 seconds. A $30 billion company was suddenly trading for under $10 million. Other stocks saw the equally irrational opposing situation. Apple stock went from $250 a share to $100,000 a share within seconds, briefly valuing the company at $54 trillion, which is almost the total value of the entire US stock market today. I really want to highlight just how absurd this is. There were 2 trades for 895 Apple shares executed at these prices. In total, they should have sold for $216,000, but instead they sold for $89.5 million. And then it just stopped. By 3 p.m, the broad stock market had largely regained its losses from the crash, although still down as it was when the day began. The crash lasted just 36 minutes, hence the name flash crash, and the violent financial event naturally raised a lot of questions. Questions which we now have the answers to. What caused the crash? Who were the traders responsible? And what does all of this have to do with a British man who discovered a hack to make millions from his bedroom? So, who is Navinder Sarao? He was born in 1978 into a typical British working class family, and his first big introduction to the world of trading was through a job at Futex Live in the mid-2000s. It was there he learned how to trade stocks, and he was really good at it. He mostly traded futures contracts. They are legal agreements to buy or sell an asset at a specific price and date in the future. So instead of just buying SPY, the index that represents the US stock market, I could buy futures contracts to bet effect on the change in price. For the US stock market, this is called the E-mini S&P 500 futures. I only have to put up a small collateral for each one, and each contract allows me to control 50 shares of the index. So I can make or lose a lot of money from small upward or downward movements. Navinda found success in trading these E-mini S&P 500 contracts, and by the time he left Futex Live in 2008, he'd accumulated about $2 million. When he left the firm, it was the middle of the global financial crisis. He believed that a bailout for financial institutions was coming, so he bet all of his money on stocks rebounding. The week that the bailouts were announced, the stock market increased 19%, and using futures contracts, he turned his $2 million into $15 million. He continued to trade during 2009, but he noticed it was becoming harder to make profits because of a new type of trading: high-frequency trading. With computers and the internet becoming much more sophisticated, automated trading was growing in use. A New York Times article from July 2009 was one of the first times it gained mainstream attention. They described high-frequency trading. Powerful algorithms execute millions of orders a second and scan dozens of public and private marketplaces simultaneously. They can spot trends before other investors can blink, changing orders and strategies within milliseconds. There are many strategies that high-frequency traders use to profit, but I'll just explain a couple of them. Stock exchanges like the New York Stock Exchange and the Nasdaq are supposed to show all of the available buy and sell orders to everyone at the same time, but they used a loophole to show some traders orders ahead of time in exchange for a fee. So slow traders placed their buy orders, but rather than being shown all of the potential sellers at the same time, some of those orders were most likely routed to a collection of high-frequency traders for just 30 milliseconds in what is known as a flash order. Yep, that's right, they called them flash orders, possibly the biggest foreshadowing of all time. By receiving orders from the exchange a few milliseconds before everyone else, high-frequency trading bots can quickly buy and sell shares for a tiny profit. High-frequency traders also benefit from competition among the various exchanges, which pay small fees that are often collected by the biggest and most active traders, typically a quarter of a cent per share to whoever arrives first. But then the article talks about another strategy, which in hindsight was essentially a blueprint for anyone who wanted to abuse financial markets for a profit. They analyzed a July 15th trading session. Chipmaker Intel had reported strong quarterly earnings the night before, and traders set out to buy another chipmaker, Broadcom, when the market opened. Beyond the genuine trades, there was a lot of stock manipulation. Soon, thousands of orders began flooding the markets as high-frequency software went into high gear. Automatic programs began issuing and cancelling tiny orders within milliseconds to determine how much the slower traders were willing to pay. The high-frequency computers quickly determined that some investors' upper limit was $26.40. The price shot to $26.39, and high-frequency programs began offering to sell hundreds of thousands of shares. Creating and quickly cancelling orders is a type of market manipulation. It was already illegal at the time, but it didn't have a specific definition in US law. It became known as spoofing because it involved making fake orders for the sole intention of tricking other traders into thinking that a stock had more interested buyers than it actually had. Navinda Sarao, who was frustrated with high-frequency traders stealing his profits, began using this illegal strategy. He built his own custom high-frequency trading bot and started trading E-mini S&P futures again. But this time, he used his bot to create thousands of fake orders before quickly cancelling them. The spoofed orders were set at all different prices to give the appearance that these were genuine trades from different traders. This specifically is called layering, another very illegal form of market manipulation. The fake market activity created a momentum in the price that he could then profit from with genuine trades. And it worked wonders. He was making hundreds of thousands of dollars a day. Which brings us back to the infamous flash crash on May 6, 2010. Navinda was trading the markets from a bedroom in his parents' home. He used his spoofing and layering strategy to profit from the increased volatility. By midday, he was placing around $200 million worth of trades, and by 2:40 p.m. ET, or 7:40 p.m. in his local time, he logged off after making $950,000. A minute later, the flash crash began. So did Navinda cause the flash crash with his huge volume of fake trades? Well, Not exactly. The Financial Times reported that Navinder's fake trades were so large they made up 20% of all the sell orders of the E-mini S&P futures at various times during the day, which in simple terms means he did add a lot of trading volume to the market, and he did push prices to artificially low and high prices so that he could profit from them. But he wasn't actually trading when the crash occurred. An official report later found that while he and other high-frequency traders did contribute to the crash, there was someone else who actually caused it. Well, actually, I looked at a number of different reports that all analyzed the trading data. The two main pieces were a study published in 2014 and the official report from the SEC and CFTC. Notably, this report makes no mention of Navinder's illegal trading activity. And that was by design. Navinder was already under investigation by the Department of Justice, and they didn't want to alert him. But I'll get back to this later in the video. The most shocking part of the flash crash is that the entire crash can pretty much be traced back to a single trade. At 2:32 p.m, a mutual fund initiated an order to sell 75,000 E-mini S&P futures contracts, a total value of $4.1 billion. Now, you can't just dump an order like this on the market without crashing the price, because there wouldn't be enough buyers on the other side. The buy-side liquidity for the E-mini contracts was under $3 billion. Buy-side liquidity effectively meaning the pool of willing buyers, and so this trade would have to be slowly drip-fed into the market. For reference, a similar trade to this earlier in the year took more than 5 hours to fully execute. So the mutual fund decided to use a sell algorithm to slowly sell the 75,000 contracts. They set the target execution rate at 9% of the trading volume from the previous minute. This limit prevents the bot from dumping too many shares onto the market too quickly. If there was $1 billion of these contracts being traded back and forth every minute, the bot would only sell $90 million worth of contracts every minute. Sell algorithms can also have price and timing limits so that the contracts aren't sold on the market for a price that's too low. This mutual fund used no such limits. Any price and any speed was acceptable as long as it didn't exceed 9% of trading volume. And that was a huge mistake. On initial thought, you might think that trading volume is a good way to see or measure how many willing buyers there are for these E-mini contracts. After all, if the trading volume is $1 billion has been traded back and forth over the past minute, doesn't that mean that there's, at least in the last minute, a willingness of people to buy $1 billion worth of contracts? This logic was pretty much true for the entire history of the stock market. Except in 2010, there's another huge element. High-frequency traders. Remember, these trading bots aren't trying to acquire or offload their own positions. They're buying and selling just milliseconds apart, often to other bots, before the real buyer acquires the contract. They don't add to the pool of willing buyers, but they do increase the volume. Between 2:41 and 2:44 p.m, high-frequency traders traded 140,000 E-mini contracts, representing 33% of total volume. Bots that had no intention of holding the contracts were driving up the trading volume. As the volume rose, the mutual fund's sell algorithm viewed this as the pool of willing buyers increasing, so it started feeding more of the 75,000 contracts into the market. The high-frequency traders were creating the illusion that there was lots of willing buyers, and when there weren't enough buyers, it crashed the E-mini market. The pain quickly spread into the actual stock market because of cross-market arbitrages. These are traders who buy the E-mini contracts and sell the SPY index to profit from small discrepancies between those two prices. But in this case, they essentially were transferring the collapsing E-mini market into the actual stock market. Within just 20 minutes, the entire 75,000 contract order had been executed on the market, an order that should have taken more than 5 hours. This 2014 study specifically looked at the role of high-frequency traders. It concluded that while they did increase the trading volume, they didn't actually cause the crash. They just accelerated a problem that was essentially created by the mutual fund that made a huge oopsie when it came to the sell algorithm of those 75,000 contracts. Navinder was one of these high-frequency traders who were not directly to blame, but did add fuel to the fire. Of course, one big difference was that most of Navinder's trades were completely fraudulent, and it didn't go unnoticed. Sometime shortly after, the Commodities Futures Trading Commission received information about some strange groups of trading orders that were made during the crash.
The data sets that we reviewed for Now's activity showed he would place these orders together and modify those orders several, sometimes thousands of times or hundreds of times before then canceling them and not getting hit.
With enough evidence, the CFTC passes the case over to the Department of Justice. The investigation took years to complete, but in 2015, Navinder was finally arrested in the UK. He was indicted by a grand jury on 22 counts of wire fraud, commodities fraud, and manipulation for trades between 2009 and 2014. The 22 charges carried a maximum sentence of 380 years in prison. The Financial Times reported that Navinder admitted to entering more than 85 spoof trades on the day of the crash. And in the DOJ statement, it says he admitted to making at least $12.8 million from the illegal activities. In 2016, he entered a plea agreement with the DOJ on spoofing and wire fraud charges. But thanks to his help in furthering US financial regulations, he only received 1 year's house arrest. The flash crash brought with it a tightening of financial regulations. The Dodd-Frank Wall Street Act was passed as law just 2 weeks after the crash. It was a piece of legislation initiated by President Obama after the global financial crisis. And among other things, it finally provided a direct definition of spoofing in US law. The crash also shed light on a number of flaws in financial markets. How large automated sell orders can trigger extreme price movements. That high trading volume is not always a reliable indicator of market liquidity. And another example of just how connected the derivatives and securities markets are. After Navinder's arrest, many believed he was essentially a scapegoat for a practice that was rampant on Wall Street. Spoofing and layering trades should be illegal, but it's also something done all the time, even by the big firms. Going after a lone UK trader for this is even more ridiculous when you consider the global financial crisis just happened, and only one person was jailed in the US for their role in the crisis. I hope you guys enjoyed this very long and complicated story, and if you did, a huge way that you can support me is simply by hitting the subscribe button. And even better, check out one of my other videos next.